Are the high 10-year Treasury yields we've seen recently here to stay? Well, traditionally we'd say the answer depends on inflation's trajectory, but something feels different this time. Now, perhaps a look back at 10-year Treasury yields over the years can provide some context. Back in the summer of 2020, inflation was crawling at a mere 0.1% year over year in May, a level considered dangerous by most economists. At that moment, 10-year Treasury yields were trading below 1%. What followed was a remarkable rally, a dramatic surge in both CPI and Treasury yields. Now, inflation rocketed to a peak of 9.1% in June of 2022, with 10-year yields climbing to 4.25% by October of the same year. But here's where it gets interesting. Inflation has since cooled, yet yields have remained surprisingly elevated. So since October of 2022, U.S. 10-year Treasury yields have averaged 4.08%, almost double the 2.09% average of the previous decade. Why? Well, conventional wisdom suggests two key factors. First, despite inflation's decline, markets believe inflation will remain above the Federal Reserve's 2% target. Second, the U.S. Treasury expected to dramatically increase long bond issuance to manage the growing national debt. So here's the question. Are yields unusually high right now, or were they artificially suppressed in the decade following the 2008 financial crisis? I think the answer might be a little bit of both. Now, for context, from 1990 to 2002, 10-year Treasury yields averaged 6.22. Back then, inflation hovered near 3%, and notably, GDP growth remained consistently positive from 1991 to the year 2000. Now, current 10-year levels have helped push average mortgage rates up to levels not seen since early 2000. But still, the housing market seems strong. Now, some may argue that it's the excess liquidity in the system that keeps housing up and has helped in narrowing corporate credit spreads to historic lows. Presently, there seems to be a growing argument that the 10-year levels we are currently experiencing are more normal than most of us initially thought. If a trader believes that yields could fall from here, they could express that by buying the February micro 10-year yield futures contract at 4.55 and targeting a move to the January 13th high of 4.80. A stop for this trade can be placed below at 4.40. This trade can make $250 if the target is reached and risks $150 if you're stopped out of your level. Now, if a trader believes that yields are going lower from here, they could sell the February micro 10-year yield futures contract at 4.55 and target a move to the November 15th low of 4.05. A stop for this trade can be placed above at 4.90. This trade can make $500 if the target is reached and risks $350 if you're stopped out of your level.